Welcome to the AAA Storage Podcast, your integrated real estate and development partner exploring all things self-storage investing to bring you diversified success. Let's dive in. Hello and welcome to the very first episode of the AAA Storage Podcast. I have an esteemed guest here with Paul Bennett, and I am so excited to get his expertise and his insight to talk to us about self-storage investing. So, Paul, tell us a little bit about yourself.
Hey, thanks, Brandon. Great to be here. I am the president of AAA Storage and also the managing director of our current offering, which is Growth Fund 1. And from a background standpoint, Brandon, I've been involved in real estate syndication since 1981, been involved in virtually every property type across the spectrum. And so this is essentially what I've done for my entire career.
So you've been around the block a couple of times, up markets, down markets. You've been through it all.
Your town. We've seen a lot of different cycles in real estate markets since 1981. So
I love that. Okay. Well, what I would love for our listeners to understand on this podcast is, with the very first episode, is why self-storage. This is a very simple question, very basic question. It's a softball for you. But why self-storage investing? Why is it different for different asset classes? What are the returns like? What is the big deal with self-storage, and why should investors think about it as part of their overall portfolio?
Yeah, that's a great question, Brandon. And the maybe the larger question about why real estate in general is a subject for another podcast, because I think there's a lot in that. But I personally believe, without any doubt, that any accredited investor should have an allocation to real estate within their portfolio, directly into real estate, not, owning real estate related stocks or that type of thing. But self-storage in particular has been a tremendously popular asset class over the last 10 years, and predominantly because it's extraordinarily resilient. If you look at all the data, self-storage has outperformed every other type of real estate, from office to multifamily to retail, in more difficult economic periods. It's simply a product that is a consumer-based product. It's not an extraordinarily expensive proposition for people to store their things, and the demand for storage holds consistent throughout more difficult economic environments. So I would say that's probably the first and biggest reason to consider self-storage as a part of your portfolio. Secondly, it's an asset class that generates above average cash flows and cash on cash returns, and is a very simple business. The expense structure in most self-storage, well-run self-storage facilities is roughly 30 to 34% of gross revenue. And so it has an extraordinarily simple model. The two biggest expenses are real estate, property taxes, and insurance. And beyond that, there's not a lot of moving parts on the operating side in self-storage facility. So it's a very efficient economic model that produces very good cash flows and is counter-cyclical in terms of its performance in more difficult economic times.
So one thing that you've talked about is there's different mechanics or metrics that you think about when you're investing in real estate. There's like cap rates and, like you said, like operating costs, and there's a couple of other metrics. Can you talk about a couple of those key metrics, part of the fundamentals of this investment, and why it's maybe either superior to other real estate investments, or maybe just regular like equity investments or things like that?
Yeah. And, cap rates are the metric that everybody's most familiar with and probably talks about the most. In the self-storage industry, cap rates tend to track multifamily cap rates plus about 50 to 75 basis points, or half or 0.75% of a percentage point. And part of the reason that they've been valued that way, particularly in the last 10 years, is the popularity of this asset class with institutional investors. There are 5 publicly traded REITs that have an insatiable appetite for property, and that's driven some of that lower cap rate environment for self-storage. There's also a tremendous amount of private equity outside the publicly traded REITs that has been attracted to self-storage because of the overall returns. And so that demand on the property product side has made the valuation of self-storage properties not look tremendously different than multifamily. However, the difference is a good multifamily project either cost to construct somewhere in the $200 to $250 a square foot range, where self-storage can be built for around $100 to $110 a foot and can often be acquired for something less than, well under $200 a square foot. So it's those dynamics kind of create a very interesting environment. As you know, others listening to this podcast may not know, we are a developer of self-storage. We tend to focus on the ground up development of new projects, and then the management and stabilization of those projects over time. One of the fundamental differences in self-storage versus any other segment in the real estate industry is the yield on cost that the product provides. And again, that's the subject maybe for a whole different conversation, but very quickly, yield on cost is the cash on cash return that's pro forma'd when a property stabilized versus its actual cost to construct. In the self-storage world, we see yield on cost in the 9.5% range is typically what we look for on a project. And if you look at every other segment in the real estate industry, a developer of multifamily, retail, office is really pleased if they can get a yield on cost in the 7.25% to 7.5% range. That's a pretty big difference in terms of the yield that a project costs or produces based on its cost to construct. And when you combine that with development spread, which is the difference between cap rates in the market and the yield on cost that a project can generate, what you see is there's about a 3-point spread between today's cap rates and yield on cost in our projects. And that 3% spread is what creates the immediate value that's realized when you develop a project from the ground up and get it stabilized. So that is another sort of economic efficiency dynamic and some metrics that we look at very carefully as we're looking at projects, and we think are a great reason to not only invest in self-storage, but invest in the development of self-storage properties from the ground up.
Okay, I feel like there's like 100 episodes that just came out of what you just said. Yeah. but I want to focus on...
And maybe I shouldn't have gone that because I can give you some examples of both. I can take that a little bit further. But you're right. That's a series of conversations probably.
Yeah. No, I love it. That's what's so cool about what you guys are offering and the way that you think about self-storage. And I don't want to, super hard pitch for exactly, this fund and what you guys are doing, but it is really unique. And so I think a little bit of detail would be helpful. So one of the things I was going to mention was something that makes you guys distinctive is that kind of vertically integrated model that you have. Part of what you just described, that you develop the properties as well. But another one in this fund in particular is that cash, when a lot of people think about self-storage investing, they think about kind of a cash flow type business where they're receiving, cash based on rents and things like that. But you guys actually lock up that cash for a period of time and then distribute the proceeds at the end, which is a little bit unique. Can you talk a little bit why you do that as part of a model? Is it helpful to get more value than more of a cash flow model, or how do you guys think about that when you're structuring the fund?
Yeah. Several places to go there, Brandon. First of all, in self-storage, there are the same opportunities to invest that there are in any other type of real estate. You've got core and core plus, which are class B, class A properties that are stabilized, cash flowing, don't need any capital expenditures. They're just sort of really nice assets. And then you've got value add, where you buy a property that is underperforming. Maybe it needs some CapEx. Maybe it has the opportunity for expansion. And then the third or fourth class would be ground up development, which is really what we're focused on. As a ground up developer, the investors that invest with us are looking not for necessarily cash flow on a quarterly basis. We don't send out dividend checks from the fund, although I can unpack that. There are circumstances where we may, but that's generally not our plan. What we're about is providing investors with the opportunity to get significant growth in their equity capital. Our track record over 30 years and 90 full cycle deals is we've returned on average across those 90 deals, a little bit more than 3 times the equity that the investors gave us to start with. And we've done that over an average 3.5 to 4 year period, which equates to an internal rate of return of about 19% on average
Amazing.
across the 90 projects. So the metrics we're focused on start with yield on cost that we talked about a minute ago, because that drives the value creation and development process, and time value rates of return. As everybody knows, a dollar you get today is more valuable than a dollar you get 10 years from now. And so we're focused on essentially being a merchant developer, where we're going to go in, we're going to develop a property, we're going to get it stabilized. And when it's stabilized, we can get full value for it in the marketplace. And we're going to sell the property and distribute those proceeds back to our investors. You talked about vertical integration. It's a critical component of what we do. But I'll go all the way back to the beginning. If you're familiar with self-storage, today there are really 2 types of self-storage. There's the drive-up self-storage that have been around forever. And then there's what we call the big box, multi-story, usually brick buildings that are all climate controlled. We have remained focused on drive-up self-storage. And we stay focused on that because we can build it, because of our vertical integration, for about $105 a square foot. The big boxes that you see, some of the big brand names doing, and even regional players that are multiple stories, all climate control, cost somewhere in the neighborhood of $180 to $210 a square foot to build, because they include elevators and sprinklers and brick exteriors, and that costs money. But the interesting thing is, if you look at those big boxes, they may get a small RIP premium over our facilities. We offer both climate control and non-climate control, but because it's a little fancier building, they may get a small RIP premium over our facility, let's say in the neighborhood of 20 to 25%. But their costs are 2x our costs. And so their yield on cost, and therefore the value creation that they have the ability to create for their investors, is significantly less than what we can create for our investors. And part of that is the product that we stay focused on and the strategy that we have. And part of it is the fact that we're totally vertically integrated, particularly in the state of Texas. We control all the resources, from the acquisition of a property to the final construction and CO, both the vertical and horizontal construction process. Outside the state of Texas, we do use third-party contractors, but it doesn't affect our cost tremendously. It's a little bit more expensive to build outside Texas. We also have our own vertically integrated property management team. We manage all of our properties. Today, we have a portfolio of about 25 existing facilities that we manage. And all the new product that we develop that comes online, it is taken over by the property management team. David Lutz, our VP of property management, has almost 25 years in the industry with AAA Storage. He's probably one of the best lease-up property strategy guys in the country, which is an important part of the process once you get it built. So we feel really confident that with our vertical integration, the product that we focus on, and our focus on yield on cost, we can drive above average time value returns for our investors. That's a lot. Sorry, I just kind of dumped the whole dump truck on you there.
No. I'm glad you did, because I think you guys are doing something so unique and have such a cool approach to the way that you think about self-storage. And that's what I was hoping we would get out of this conversation, because there's self-storage, but then there's, the AAA way to do self-storage. And I wanted to highlight a little bit of that, because there's so much to think about, and you guys being, experts and having so many decades doing this, that you've got a great way to do it. So I'm glad you went into the detail. But
let me give you a quick example. The vast majority of offerings that are out there today are acquiring existing self-storage properties. Some of them may have a little more of a value add component, where they're buying mom and pop facilities that haven't been well managed, or maybe have a little room for expansion. But they're distributing income to their investors, which is a great thing. And it's exactly what some investors are looking for. Our whole strategy, and I said a minute ago, I could give you an example. I'm going to give you a very quick example of the value creation in development of self-storage, which is what we're very specifically focused on. If you have a property that costs $10 million to build and has a $950,000 pro forma NOI, that is a 9.5% yield on cost, if you do that math, which is about where our portfolio sits on average. Some a tick higher, some a tick lower, but on average, that's the target we shoot for. Once that property is stabilized and it cost us $10 million to build it all in, when you put a 6% cap rate on that $950,000 NOI, the value of that property is $16.5 million. So if we've leveraged that 70-30, which is our typical leverage is 70% loan to cost, that means our investors had $3 million of equity in that project that we built for $10 million. We sell it for 16, pay off the $7 million of debt, and send our investors back $9 million. That's the power of development. The development opportunity in self-storage is the ability not to just distribute income, but to create true growth in equity, and give our investors an opportunity to get, in that 2.5 to 3.5 times their equity investment back as a return.
Do you take American Express, or can I? Just kidding. No,
well,
that
I'm enthusiastic about what we do, and I really believe in what we do. It's not for everybody. Some investors, their objective is income on a steady basis, and there's nothing wrong with that. But for investors that are looking to grow their capital base, I can't think of a better opportunity to consider as a part of a portfolio than the development of self-storage. And P.S., there's a little bit of risk in the raw land piece of any development activity. Buying land, getting it permitted, getting it ready for construction has some risk in it. In order to strip that risk out of what we offer investors, we land bank land and take it through a process to get it fully permitted and ready for construction before it goes into one of our investment vehicles. So our investors aren't taking that raw land risk. There's still a tick more risk in development, in theory, than there is in buying an existing stream of cash flow. But again, if the risk in self-storage is generally less from a lease-up standpoint than it is in the other aspects of the other segments in the real estate industry, because it's a consumer-based product with very broad demand, and it historically has performed very well.
So I'm hearing less risk, greater returns. This is perfect. It sounds really great.
I would say there's more there. I mean, I wouldn't be truthful if I didn't say there's more risk in developing anything than there is in buying a stabilized, real estate asset.
Yeah, of course.
However, I think if you look at it from a risk-adjusted return standpoint, where you compare the degree of risk to the incremental return, self-storage comes out on top.
I love that. Okay, well, what I want to do with the rest of these, we got many more episodes coming, and you highlighted a lot of different, segments of the business and the way that you guys think about self-storage. But, in the future episodes, I want to talk more about, like, how do I get started in this? How did you guys get started? How do as an investor, maybe I want to start up my own, kind of development practice. How do I do that? Just kind of walk me through the mechanics of what it looks like to get involved in this world that you're painting this picture. But also, what are some case studies of investors you've seen in the past? How have people gotten involved, and what does that look like from an investor point of view? And then I also want to talk a lot about what are future trends that you're seeing in the self-storage space and the real estate market in general, because obviously we're having inflation. There's bond yields are elevated right now. There's a new administration coming. There's just a lot of different things that may be happening, and I think it would be helpful for investors to understand your point of view on the world, because you are such an expert and you have such a great team. So in future episodes, I hope listeners will stay tuned and be focused on those kind of things. And if you have questions, please send them to the team. Like what are things that are on your mind when you're thinking about real estate investing, self-storage investing? What can the team address for you? Check us out on social, check out our website, get in touch with the team. Like, let's have this conversation, because I think You've got some real experts here that can provide so much great information. And I want this podcast to be a place for that. Build this kind of community where we can all help each other succeed, grow portfolios, improve land values, improve asset values, and really make a difference. So, Paul, I'm so grateful for you and your expertise, as well as the rest of the team, Andrew, Mike, John, some of the others. I know you guys are doing really amazing things, and I'm really grateful for your time, and I'm very excited about this podcast. I think it's going to be a lot of fun.
Hey, Brandon, thank you. It's been a blast, and I look forward to doing some more. As you know, I'm not short on opinions, so.
I love it. More opinions, the better. I love it. This is great. All right, man. We will see you next time on episode number 2. See you next time.
Great, Brandon. Thanks.